Well, good afternoon or good morning, depending on the time zone. Today we're going to go through a combination of some research we've done in the past and some current events, some of the data that's coming in, and talk about the implications this has for underwriting quality and basically loan origination and the next economic cycle. What we're seeing makes us think that it's time to start paying attention to these things. So I want to take you through how we see that and why we are paying more attention than normal right now to these issues. The presentation here, the first part of the presentation is work that was done with Jose Canal Cerda at the Philadelphia Federal Reserve. Of course, he has his disclaimer that this is the research presented here is not necessarily official opinion of the Philadelphia Federal Reserve. So the goals for that research study were to use a large mortgage data set, LP Analytics, and to go through and study changes in consumer appetite, looking in particular at the last mortgage crisis. To do this, we used a vintage model, an age period cohort model, as a way of capturing the broad trends, and we combined that with a loan level origination score because we want to ask the question, do the variations in the credit cycle that we see correspond to changes in underwriting? Basically, are these known effects or are these accidental effects? Where does the credit cycle come from? So that first stage analysis, we are actually showing some of the results on this slide. We segmented the data into subprime, prime, and super prime risk bands, looking at this by FICO. We also looked at variation in credit quality by FICO, but we looked at the economic environment by state. So the way an age period cohort model works is that we take vintage performance data and the algorithm splits that into a life cycle versus the age of the loan. That's in the upper left corner. A credit cycle measure by vintage origination date, that's on the bottom. And an economic cycle, that's in the upper right corner where we've got one line shown for each state measuring changes in the environment. So the graph in the upper left is measured as the, this is actually a percentage, so these are very small percentages, but monthly, what's the rate? Oh, actually, this is delinquency, sorry, so it's not such a small percentage, but what's the monthly delinquency rate versus the age of the loan? That, you can see three different functions there. The bottom one is super prime, that's where, of course, you have the lowest default rates. The highest one is subprime, and they have a little different shape. On the scale, it's a little hard to see, but the subprime definitely peaks earlier. The superprime at the other extreme tends not to peak at all. It's just a gradual rise. Now, each of those life cycles forms the baseline against which we compare. So if I look at the credit quality graph on the bottom, the zero line here is the life cycle. If I'm looking at the subprime credit quality graph, that zero line is the subprime life cycle. So these are all relative changes we're measuring. And the scale is change in log odds. So what's interesting about the credit quality is that the variation in log odds for something like subprime is actually less than the variation that we see for superprime. So this measure of the credit cycle is more dynamic for the better quality loans. And it's because it's on a relative basis. So where you have a high loss rate as the baseline starting point for subprime, the variation around that high loss rate is less than if you're looking at superprime. So from that perspective, you know, kind of a percentage change type of measure, it's not such a surprise. All three of these graphs are measured non-parametrically. It's just every point is a dummy variable in this analysis. And in fact, this is a Bayesian analysis that's performed. There's a specific algorithm called a Bayesian age period cohort model that you can look up if you'd like to replicate the analysis. And so that approach means that each point here on the vintage graph, the credit quality, is a measurement looking at the historic data for those vintages and normalizing for life cycle, normalizing for environment. So this is a pretty pure measure of what the credit cycle looks like. When did we have better than average credit quality? That would be back in 2003. You can see all these graphs are in negative territory. A -1 on a log odds scale, that's like having half the delinquency rate that you normally would. At the other extreme, you can see that in 2006, 7, and 8, credit quality deteriorated rapidly. The worst case is late 2007. For the super prime vintages, that log odds scale is about 1.5. That's something like 4 times higher than average delinquency rates. So that's quite a range of variation there. And then, of course, as people started looking forward to recession and increasing losses, that credit quality improved dramatically into 2009. So this is what we think of when we're talking about credit cycle. It's not a cycle of losses, because losses really come from a combination of credit quality and the economic conditions. So in the upper right, this is meant to capture the economic conditions. And you can see pretty clearly there's a period of higher losses back in 2003, 2004, improvements in 2007. That's really the best point in the economic cycle is 2006, 2007, and then deterioration in the economy in 2009. So if you compare the economic cycle to the credit cycle, you see that the credit cycle precedes the economic cycle, that the good loans are coming actually on the tail of the last recession. The worst loans are coming well before the beginning of the recession. So in good times, we're booking good loans. In bad, or actually, as the economy is starting to improve is when we book our best loans. As the economy is starting to deteriorate is when we book our worst loans. And I mentioned that these are non-parametric measures. Here's an expansion of a few of these states, and it's always worth highlighting some things. You'll see here in 2006, there are a couple of states. These are Louisiana and Mississippi that had much higher losses than what the rest of the states did, where the economy seemed to be doing well. Those 2 states didn't do so well. And, of course, the slide here gives it away. That's Hurricane Katrina. So this is important because when we look at the credit quality, we've cleaned away all of the environmental effects, whether they're economic or a hurricane or a bankruptcy law change. Whatever it is, that impact gets normalized for. We're also adjusting for the different ages of the vintages. So for the more recent vintages in this study, we didn't have as much data, but it's compared to the early parts of the life cycle. So it's an early indicator of what that quality is. Now, the next part of the analysis is a loan level model. The loan level age period cohort model, this is really a GLM or a discrete time survival model, would be effectively the same kind of model. What we do is we take as inputs the life cycle and environment when we make a logistic regression model, and we also include scoring factors and dummy variables for the residual vintage effect. So this structure means that at the loan level, we're saying we know the life cycle as an input from the APC model. We know the environmental function as a fixed input. Let's take as inputs the scoring factors to see how much of the credit cycle we can explain with the things we know. And we'll leave some dummy variables by vintage to see what the residual is. What is it that we can't explain? So here you can see the kinds of variables that we use for that explanation. We have things like, was it a jumbo loan? Was it a low doc loan? What was the FICO at origination? All of these things are at origination because we don't want to use things like delinquency because that's going to get confused with credit quality and economic environment. basically delinquency is a product of the quality of loans you booked and the economy that they're living through. So that would be redundant with what we're trying to measure here. So instead, we're just asking the question of what you knew at origination, how much could you have explained in this credit quality? So source, channel, occupancy, PMI, term, purpose, LTV, all the usual things, and the values that we get here. If you really go through and study these things, you'll be able to see this recording later, so you can come back and study if you like. They make sense. There are no surprises here. So what does that give you? This graph compares the vintage function that we get from the age period cohort model with the vintage effects, so the unexplained dummies from the previous model. So the dashed line here is how much of the credit quality could not be explained by the model that I just showed you. It's the vintage dummy variables. That's the dashed line. The solid line is the original measure I had of credit quality for the economic cycle. Now, the first thing to see is that they're correlated. They both move together. But the other obvious effect is that the residuals from the loan level model are about half as much variation as the full vintage model. In other words, the difference between these two lines is what my credit score can explain. So that dashed line is what it couldn't explain. So basically, what we knew at origination through the last credit cycle could only explain half of the actual variation observed. So half of it was unexplainable just by looking at credit quality factors like FICO and LTV. So that's the big mystery here. We all know that underwriting standards were loosened prior to the last recession. That's part of what created the credit cycle. We know about the story of subprime lending and low doc loans and all those things. But we've explained those effects here in this model. There could be other things, things that bypassed underwriting standards, cases where basically people found alternate ways. But I have to point out the alternate channels and the alternate products. We've filtered out alternate products. There are no negative amortization loans here, no option arms. All that stuff is removed. These are 30-year fixed mortgages. So in that somewhat limited universe, we still have this variation that needs some explanation. One question that's asked is, do we see this by all of our different score bands? The previous slide was a summary of all the data. And interestingly, that part that is left unexplained is identical, more or less, as you look across these different bands. That to within estimation error, these curves are the same. So it's saying that we have the same lack of explanation across the full spectrum of risk grade. And by purpose, looking at purchase, other, refi, one question asked was, is this a refi effect or is it a new purchase effect? There is an offset in terms of the purpose causing different levels of overall risk. You can see that the purpose for other is different than new loans and refis. I honestly am not sure what other means, if it's not a new loan or a refi. But clearly in the data, that's a different credit risk. But the pattern persists, and really we're looking at the cycle here more than the level. So we had an idea. The Senior Loan Officer Opinion Survey, SLOOS, asks senior loan officers what they're doing in a couple of areas, and one of them is changes in underwriting standards. They have a scale, and if every lender that they surveyed said that they were tightening standards, then it would be 100 on the scale. If everyone said they were loosening standards, it'd be minus 100. So this is essentially a percentage looking across there of increasing or decreasing standards. When we compare these two, first of all, visually, the dashed line there looking at those who are tightening standards is really rather flat until about late 2007, 2008, when everyone starts tightening standards. If you compare that to the vintage effect, the credit cycle that we observe, statistically you'd say they're uncorrelated. But if you allow for the margin of error and just look at the reported sign, it's actually the wrong direction. That it would say that in 2008, when they were tightening standards, actually they were still booking risky loans. So at best, there's no correlation here between self-reported underwriting standards and what's actually observed in the credit cycle. So that's interesting, to say the least. The next one here is the same survey asks the same people if loan demand is rising or falling. And actually, we have, in that historic survey, we have to piece this together because they change the questions sometimes. So the older part of the line is all mortgages. The more recent part is just the prime mortgage part of that. And interestingly, this actually correlates quite well. And it correlates in the direction you would expect, that it says when, or actually whether you expect this, I guess, is the whole question here. But what it says is that when consumer demand is high, credit quality that we measured from the data directly is good, is better than average, lower risk of default. So in 2003, high demand, low loan risk. In 2006, 7, 8, low demand but high loan risk. And that's the pattern that we see. The short answer here is that when consumers want loans, the risk is good. If consumers don't want loans, the risk of the ones you originate is poor. So what causes that? What causes loan demand to change? Now we can get a longer history of that SLUICE survey. If we look at all consumer loan demand, that goes back to about 1990. If you compare that to things like changes in interest rates, here's the 24-month change in the mortgage interest rate. We did a scan across all the different possible windows here for that change, and 24-month was the optimal value. It's just empirically measured. And you get the same quality of correlation as what we saw previously, that basically when interest rates are falling, let me pick a period here we've been talking about, like in 2000, what you see is low demand and high rising interest rates. In 2002, you see interest rates falling and rising mortgage demand. In 2006, 7, 8, where we saw poor quality loans, you also see rising interest rates and lower demand. So there's no mystery here that if interest rates are rising, consumers are not enthusiastic about taking out loans. But you have to, this is not just on volume, it's not all consumers. The credit quality story tells us that it's a certain group of consumers, that for a known FICO band, for a known LTV on the loan, you're trying to normalize for everything you can, and yet there's an adverse selection effect, a self-selection effect on the part of the consumer. Some of these consumers are value shoppers. They may be, in all other respects, just like their neighbors, equivalent home being bought, equivalent FICO score and history, and yet some of them, when they see rising interest rates, pull out of the market. Others do not. And the ones that don't pull out of the market will, in the end, be observed to be higher risk. So that self-selection means that we have value shoppers, or we have consumers, the pool of consumers changes through the economic cycle. They're not always the same people. And so here, pulling this out more recently, looking directly at the vintage effects and the 24-month interest rate, you can see that those things line up. So the previous two slides did this in two steps, one looking at credit quality to mortgage demand, and then mortgage demand to economics. And here, if you correlate them directly, you'd find the same thing. So the conclusion here is that underwriting is the process of selecting the best consumers from those who apply. But the first order effect is who chooses to apply. And we often think of that as kind of a static pool, that we don't always think about the fact that there is consumer adverse selection, that we don't always get the same pool of applicants. We do talk about adverse selection, one lender versus another as they change policies, but we see this on a macroscopic level, that the economy drives this kind of thing. Now, this was not actually the first study we had done on this. Just to drive this point home, some years previously, we had gotten vintage aggregate data. So we couldn't ask the question about normalizing for FICO and LTV and everything else. All we could do was ask, what does the credit cycle look like and what drives the credit cycle overall? So as some confirmation of what we just saw, here's some other credit cycles. And the blue line with the crosses here is the vintage effect. So we've done the same age period cohort analysis. We've pulled out the vintage function. And if we look at that, you can see that that study ended in 2006. We were already using that study to predict bad credit quality coming in the door and continuing going forward. And what you saw from the more recent study was that indeed 2007 and 2008 were quite a bit worse on this scale. They would have gone up a lot more. So what this is showing is that that wasn't a fluke. We do, in fact, have a credit cycle. You can see a burst of poor quality originations back in 2000 and another period back in 1995. In fact, in 2001, 2002, lenders were asking us if we had an idea of why the 2000 vintage was so bad. Well, that's what this study is about. We see that there are credit cycles, and what you'll notice is that every time there's a period of high-risk loans, 95, 2000, 2006, and 2007, on a relative basis, the origination volume is less. So there's a period of high volume growth in 93, 94. When that comes down in 95, credit quality deteriorates rapidly. In 99 and 2000, when the volume fell off, the credit quality of what was originated deteriorated rapidly. You can see in 2000 was actually the period where the most mortgages were originated. And the quality was very good. But the volume started to fall in 2004 and 2005, and the credit quality deteriorated. So far, that was all a normal economic cycle. What happened after 2005, 2006, when people talk about the moral hazard of securitization, the securitization boom didn't really take off until 2006. It just began in 2005. So the credit quality deterioration was well before the securitization boom. So this is more than just moral hazards and other underwriting flaws. It's a credit cycle. And when we look back at that credit cycle and compare it again to things like here we've got the credit cycle with the blue line again and the banks reporting loan demand. So the previous slide showed volume. This slide shows the SLUIS mortgage demand. It's a very nice correlation historically. You can see that every time we had poor quality loans, we had low demand from consumers. I should say that there's a period here in 97 where demand was headed back towards zero, hadn't quite gotten to zero. We didn't see the deterioration so much. But overall, that's a pretty good correlation. We know from the more recent study that correlation continued. And using this, we actually ran this back previously. We looked at two different models. If you made a model that predicted credit quality from economics or a model that predicted credit quality from the Senior Loan Officer Opinion Survey, you get these two different predictors here. The one from SLUIS is the red line, the one from economics is the blue line. What actually happened, now that we have the data, is about halfway in between those two. So they both are giving us a perspective on what might happen in the future. Now, what is happening is the question. And what we see here is the most recent data. Well, it actually extends back because we want to show what those cycles look like in the SLUICE data, but you can see the more recent data as well. The survey I mentioned changes. So the older data, they simply asked for demand for all mortgages. In the more recent data, they split that up by prime, subprime, or even many different types. What you'll notice is that the cycles are pretty much the same. And this may be psychology. It may be hard for respondents to know the difference between all these different types of mortgage. They're agreeing on overall demand and slicing it up a bit as you go through, but they don't ever go in different directions. Consumer demand, we have some similar patterns. It's not quite as dynamic as mortgage. If we look here at mortgage, that swings back and forth quite a lot. Consumer isn't swinging around so much, but you can see consumer loan demand, which would include auto, card, anything else, was good back in 2003. It was poor in 2007 and 8. It was good again in 2011, 12, et cetera. What we find for other products is that the credit cycle in mortgage is the strongest. The credit cycle in terms of variation in credit quality is about half as much for auto. And for credit card, it's about half as much again. So when we look across here, we expect this to correlate to credit quality in all those products. They're all following more or less the same cycle. And most importantly, and the reason for this webinar, is that in the last 2 months, we've actually crossed into decreased demand. Demand is no longer rising across the spectrum of mortgage products. And if I look at, I said mortgage, but I mean retail loan products. Here in mortgage, it's about neutral. In consumer, it's actually falling more than that. And then if we look and compare consumer loan demand historically to underwriting standards, what's interesting is that underwriting standards are actually improving in the most recent couple of periods while demand was falling. This is different than what happened in the past. In the past, we said there was no correlation between underwriting standard and demand. But it may be a case where lenders overall, where the industry in total has learned something here, that when we're more concerned about the economy and the consumers appear to be concerned about the economy, what we find is a tightening up a bit of standards. So lenders may be anticipating this. We also have data here for commercial loans, CRE and C&I of different types. These have quite strong cycles for demand, and you can see that at the end of each recession, during and at the beginning of recoveries, there's less demand for commercial loans. That demand picks up well into the recovery. What we see is that in the current economic cycle, peak demand for mortgages, for commercial loans, was around 2013, 2014, 2015. By the time we get to the end of 2015 and all through 2016, the rate of increase was declining. In 2016, we did not have decreased demand, just not as much growth in demand. When you get to 2017, now we have decreased demand. Demand for commercial and CRE loans is falling off. And so here's a summary overlay of all consumer and all C&I, and you can see there can be a lot of correlation between them. Sometimes in the past, there'll be a disconnect between consumer and commercial, but through this economic cycle, they've been correlated quite closely. And here, this says loan demand. I'm sorry, that's a misprint. This is actually underwriting standards. And so what this shows is that underwriting standards are being tightened quite a bit on CRE and C&I, especially in CRE. Now, you can the headlines are coming out pretty frequently about problems in CRE, that there's concern about excess capacity in retail space, strip malls and such, excess capacity in grocery store space. So with those things in mind, it's no surprise that underwriting standards are being tightened on CRE. They have not been tightened so much for C&I lending. You can see that most recently it's right around neutral. If demand keeps falling, this will be something to pay attention to. Now, with looking at those things, actually, let me go back. When we look at consumer demand and commercial loan demand and compare these to economic cycles, it's no surprise that when loan demand starts to fall, a recession is not too far away. On average, it's about 2 years, looking back through this data and the previous economic cycles. Of course, many things can affect that, but on average, 2 years is kind of what you'd expect. So if we look more widely across the economy right now, it's also interesting that we're getting a change in the yield curve. What we're showing here are the basically interest rates off of different treasury bills and bonds. So what is the yield on those things? And what you're seeing is that short rates are rising, but long rates are falling. And so that flattening of the yield curve, if we compare the rate of change in the yield curve right now to what's happened previously, you would say that we might be a couple years out from the next recession. So that said, of course, many things can happen. We do expect short-term rates to keep rising, but Alan Greenspan came out recently and said that that we have a bubble in bond prices, and that long-term rates are going to have to go up. So if that happens, that would change the signal from the yield curve. In fact, many things could be done in the political realm to spur economic growth. So 2 years is a long time, but it's not a long time with lending, and that's always the challenge. If there's going to be a recession 2 years from now, your 5-year auto loans will still be around. Your credit cards that you're originating today will still be around, at least a third of them. Your mortgages, at least half your mortgages will still be around in 2 years. So that means when you're doing pricing, we are at a good point in the economic cycle. Unemployment is low. So if you're doing pricing and there's a chance of a recession in 2 years, at the very least, of course, we have to consider reverting to some kind of a long-term average for most of that pricing. We certainly can't price assuming that the current economic conditions are going to persist. There are plenty of risk indicators that we have a cycle, not a flat point, and so we have to take that into account. And so a couple things to keep in mind when we talk about underwriting and the credit cycle. Everything I've shown so far is the entire industry. The industry is not the same as an individual lender. Industry trends based on overall consumer demand give you one perspective on what that pool that you're choosing from looks like. But an individual institution, when they look at their credit quality data, they may not see the credit cycle the same way because they're choosing from that pool. And so if a lender at a good point in the economic cycle says we want to grow volume, the normal way to grow volume is to take on more risk, to loosen standards. So even though the economic cycle may say that consumer demand is high and credit quality is good, you can still book poor quality loans by loosening standards too much. So industry versus institution, these are two different dimensions really. One is the overall pool and the other is who you select from that pool. Now, what are we going to do about it? The first thing is credit quality monitoring. The example I'm showing you here is one of our clients. They've been gracious enough to let me show this example. And this is a vintage analysis of basically their default rate, their account loss rate. And it's an auto loan, so you can see for a 5-year product, they get peak losses around month 20. Relative to active accounts, this is a competing risks model. So the conditional probability of default, if the loan lasts for 20 months, then that's the peak risk. You can see some residual risk after the end of a 5-year term loan because of any loans who get extended a bit. In the lower left, you see the economic cycle. For this lender, a very sharp peak in 2010 related to the economic cycle, recovery from there and some of their dynamics. In fact, their local market is suffering because of oil prices. In the lower right is seasonality, not much to say there, but pay attention to the upper right. So the value of a vintage analysis or looking at residual risk relative to your underwriting models is to do monitoring of credit quality. So here in this vintage model, I have life cycle, environment, seasonality. The one in the upper right, which is that credit quality, this is cleaned of all those other effects. So I've got a fair comparison of new loans and old loans, of different parts in the economic cycle. And if you read across here, some of this makes a lot of sense. In 2006 and 7, they had higher risk loans, as everyone did. In 2008 and 9, they got very conservative, as everyone did. In 2010, they got more aggressive. In 2011, because the economy was improving, so they could book higher risk loans and get compensated for it. So this increase in risk is paid for. In 2014, this is an example of when you want credit risk monitoring. This was a case where they were wanted to book more loans, but there was a little bit too much enthusiasm, too many manual overrides, that sort of thing. And so the credit quality that came in deteriorated too much relative to the pricing that they could get. And so they had to course correct. And that's where you see an improvement from 2015 into 2016, a dramatic improvement because of changing policies, removing manual overrides, things like that. And that improvement persists today. So this is how you can use a graph like this for that credit quality monitoring. And of course, we have higher uncertainty in the most recent loans, but we have to pay close attention to those as we start into that next economic cycle, because of course, a crisis is always about pricing. It's not about what loss level you're going to have, it's whether you can get paid for that level of losses. So we need to keep an eye on this credit quality and compare it to what pricing we can get. I should point out just a tiny bit of marketing here. The tool that I'm showing is a tool that we sell for this very purpose, for forecasting, monitoring, validation, and so forth. So if anyone has interest in that, please let us know. Part of what we do with that tool is the other thing that you would want to do right now. Monitoring credit quality, monitoring the economic environment, those are key things, and then using scenarios for those. What if the economy deteriorates from here? What if I change my underwriting volumes? What if I change my credit quality? That sort of what-if analysis is what we're showing here. You can see the history and a couple of different scenarios for different economic environments, different origination, actually the same origination plan, but you could do many different origination plans. So the idea is that running scenarios, what-if analysis is really critical when you're facing a turning point. And if we're within 2 years of that next recession, then this is exactly when you need to do what-if analysis on what you're underwriting. In fact, I learned a long time ago, I got started in this business by being sent to countries in crisis to build models. And I can tell you that when the crisis is ongoing, that is the worst time to build the model because it's too late to help. Everything's already been booked. The way to help prepare for a crisis is to build the models in good times and use them before you have a crisis so that you're prepared when it comes. So the best use of all these tools is to prepare for that next crisis now. This is the ideal time to think about credit quality, volumes across different segments, different products. And I have to say, with CECL coming in, you can see a CECL tab in this screenshot. all of this changes because now your loss reserves by product are going to change, and your various capital ratios and efficiency ratios depending on how much loss reserves you have to hold. So not only do we need to think about that next recession, but we need to think about the portfolio mix given what's going to be changing under CECL. And coincidentally, we're going to be implementing CECL right around the time that we're worried about that next recession. And if you want to see what that means, we have a study on CECL looking at all the different ways you can implement it. We used, again, U.S. mortgage as a test case, and we're happy to share that as well. So I will pause at this point and take any questions for anyone who's out there. I'll take that as good enough for now, and unless somebody's coming in. But I thank you all for attending, and we'll make a recording of this available later to look again. So thank you and have a good day.
Thank you. Really good. Thank you.